Hi, this is Ken Boyd, and this is Understanding Stocks and Bonds. As a personal investor, you want to be able to invest in something to plan for retirement, and typically the vehicle that you're going to invest in is either a stock or a bond. That's because stocks and bonds are the primary way that companies raise money to run their business, so as an investor, that's what you invest in. Let's talk about both of these topics and try to relate them to something you already know. Let's start off with bonds. Most of us have borrowed money to buy a car or a home, and in that case, we deal with something called principal and interest. So when you take out a car loan for $20,000, and let's say it's a 6% interest rate, you're going to pay $20,000 times 6%, $1,200 as interest on your loan each year. And let's say that at the end of 5 years, you're going to repay the principal amount, the amount that you originally borrowed. Now, in most cases on a car loan, you're repaying that principal over time, but let's just say you pay it at the end. In the same way, companies issue corporate bonds, and corporate bonds are typically the vehicle that people use to invest in bonds as an investment. So let's say Sally's borrowing $500,000 to start a restaurant. It's a 6% loan due in 10 years. So Sally's going to pay $500,000 times 6% or $30,000 in interest each year. She's going to repay the principal amount at the end, the $500,000. The risk to you as an investor who buys Sally's bond is you're a creditor just like a bank. And the risk to you is that Sally's restaurant doesn't generate sufficient sales and earnings to repay the principal amount and the interest payments each year. The benefit is you have some certainty because corporate bonds pay semi-annually or twice a year. So you're going to get that $30,000 in interest in two $15,000 payments every 6 months. That's a benefit. And another benefit is you have some certainty that she's going to repay you the principal amount after 10 years. So that's a bond investment. Stocks, on the other hand, mean equity or ownership. If instead Sally decides to sell $500,000 of stock in her company, she gets cash, and the people who invest the money are investors who buy stock. There's two benefits to owning stock. One is that the value of Sally's stock will increase in value because she generates sales and earnings, and people in the marketplace think her stock is more valuable and therefore they're willing to pay for it. So one way you can profit is by having a gain between what you sell your shares of Sally stock for and your cost of Sally stock. The other way is that you can earn a dividend, which is a share of the earnings of Sally's restaurant. Sally can decide to pay a share of her restaurant's earnings as a dividend to you. So you can get dividend income each year as a stockholder. You can also benefit by selling the stock for a gain. Those are the two ways you can invest on a very basic level for your own personal investments, stocks and bonds. Thanks very much for watching.